afternoon. This is Lance Bryce with Thrive Mortgage. Today is the 17th of February, Friday. Well, it has been a challenging couple of weeks for interest rates, y'all. Mortgage News Daily, the tracking for a 30-year fixed conforming loan has the national average today 6.80%. Last week, we were at 6.5% on Friday. Week prior to that, on Thursday, the 2nd of February, we were at 5.99. We were kind of celebrating that low watermark, that multi-month low just 2 weeks ago, and we put out some cautionary notes that if you had loans to lock, to get them locked 2 weeks ago Thursday, because we were likely to see those rates increasing. Now, when we said that, y'all, we didn't think that they would increase this much this fast, and we covered some of the reasons why in the last call. That non-farm payroll that came out last Friday really rattled, or 2 weeks ago Friday rather, really rattled the markets much stronger than expected. The consumer price index that came out this week was also much higher than expected. And the producer price index kind of cemented the trend by being stronger than expected as well. And when I say much higher, CPI was not hugely out of line with expectations, but it was in the core numbers a bit higher than expected. And on the heels of that employment report 2 weeks ago, the Fed didn't need much in order to really take a more hawkish look at where interest rates need to go. As a result of that, you see a number of institutions out there that are expecting the Fed to now raise 3 times this year, not the 2 that had been fully priced into the marketplace. So the market is fully expecting now an additional 0.75% over the next 3 Fed cycles, a quarter point each, rather than 2 quarter-point hikes for a half-point increase in the federal funds rate. So that's not something that the bond market is responding well to. We've seen really strong sell-offs over the last couple of weeks as a result of all of that news. The bottom line is, y'all, inflation is being a bit more stubborn than we had hoped, a bit more stubborn than the bond market was banking on, and that reality is now having to be priced into the fixed income markets. That has pushed our interest rates up almost a full point in the last 2.5 weeks or so. In any event, we're going to continue to track this. Folks always ask me, well, what difference does that make? We've moved 599 to 680. Well, what that means, y'all, is in the last 15 days, we've lost $35,000 in purchasing power for the same payment. If you borrowed $400,000 at 599, you would have had a $2,396 payment. That same amount of money borrowed at 6.80 is $2,608. So that's a $212 a month difference. $212 a month at 599 would have bought you a $35,400 more house. So that's what we've moved in a week, and that's why it matters. Y'all, when we say we've got a strong locking bias, and when we give advice to go ahead and secure a particular day's pricing, we're doing that for this reason exactly. When we have this much volatility, when folks see a rate that they like, or at least get guidance that they need to grab what the market's providing, they really should, as soon as they've got a contract, consider locking in to get that safeguarded so that we don't see the kind of losses that we've seen this last 2 weeks. So in any event, hope this information is helpful for you and for your clients. Hopefully, as we do these over time, some folks will be protected. They'll lock when they should. And hopefully some folks will save money as a result of that. That's why we do these calls. And of course, we're always honored to have your referrals. You have all my numbers on the screen. Look forward to working with you soon if we haven't already worked together. Stay blessed, stay safe, and we will talk to you next week.